So I'll just get right into it. These are the 5 real estate investing tips to live by. These are some of the most important tips that you should keep in mind anytime you're investing in real estate. The first one is that you make money when you buy. And this is absolutely crucial when it comes to investing in real estate. You either need to be buying into equity or buying into cash flow, or maybe just a combination of the two. Don't do what everyone else does, which is buy something at market value for market rents without allowing yourself any room for improving these things, and therefore also improving your investment. This gives you a huge safety net and a lot of wiggle room in case anything goes wrong. You overspend on renovations, maybe you miscalculated something, or maybe just the market ends up going down. If you're buying into a significant amount of equity or cash flow, it almost just eliminates the majority of your risk going into that investment. And this doesn't mean that these deals are ever easy to come by, because the truth is they're not. The thing is, everybody else is looking for the same good opportunities and investments as you are. So it's going to be something that's going to take a lot of time, a lot of searching, patience, and perseverance to actually find something like this. When that magical moment hits, when you can buy into a lot of equity, when you can buy into a lot of upside and cash flow, you can make a ton of money by doing so. Keep in mind, this doesn't always mean that you'll just need to buy something under market value. You could be also buying into something with just immediate great cash flow instead. Or you could buy into something where you can strategically remodel it to improve rents and therefore improve your investment at the same time. But ideally, there should be some type of upside when you go and buy the property, either buying into immediate equity, buying into immediate cash flow, or being able to do renovations to improve those and therefore boost up your investment. The second rule to live by is to never fall in love with your investment, and this is something I see way too many people doing. They initially go out and start looking for the perfect investment, but then fall in love with a home because it's super charming, it's got a lot of character, maybe it reminded them of the home that they grew up in, despite it being just an absolutely money-sucking, terrible investment. But hey, maybe the property just has a really good vibe to it, right? Point being, this is an investment. You just can't ever get emotionally attached to a property that you're going to be investing in for the purposes of being an investment. Now, this is a tough one for some people to do if they're naturally just sentimental and emotional about their decisions. Now, it's one thing to trust your intuition and to trust your gut about something, but it's another thing entirely to ignore all the red flags, all the really bad P&L statements, all of just the money-sucking negativeness of a property because you feel good about the property and because you're attached to it. Ideally, you have to be completely detached and unemotional about what you're buying. It doesn't matter if this home is the one or the cutest home ever or just the best ever, and this is it, and you can't lose it because I've heard it all before. It's an investment. At the end of the day, what really matters the most when you're doing this, the whole point of doing this, is for money. It's all for money. You're making an investment for money. You should not get attached to your investment because that will cloud your judgment when it comes to making money. The third rule to live by is to have a bigger picture with a laser-like focus. When it comes to investing in real estate, it's a very localized economy and every single city is going to be different. Don't get too caught up with headlines and national trends because at the end of the day, real estate is really such a micro economy. Every single property in every single city is like its own little investment opportunity. Think of real estate almost like stocks. Every single stock is going to be different. You can have the same stocks in the same sector and one is going up and the other one is crashing to the ground. Think of real estate investing a little bit like that. And it's the specifics of every single property and every single investment that really makes the most difference. You know, even though the markets can trail economics in terms of going up overall and down overall, like I said, every single city is different. Real estate is such a localized investment and your market will have opportunities going on outside of everything else. So it's really important that you make sure to do your best to find those deals and then hold them. Now, of course, you can also follow wider data and trends. This will have an overall impact on the economy and who's buying or selling. But at the end of the day, when it comes time to invest, it's so important that you have a really laser-like focus on the area that you really want to invest in, because that area will always have its own individual deals where it's a good value outside of everything else. My fourth rule when it comes to investing in real estate is to have a long-term outlook and also get a fixed rate loan. Buy once and hold. Even though you might be able to get a much lower interest rate by getting maybe a 5 to 10 year adjustable rate mortgage, which just means that your rate is locked in for that term, you may as well, if you plan to hold the property long term, lock in the longest term you can now at a fixed interest rate, especially while rates are overall still pretty low. Otherwise, what's going to end up happening is that 5 to 10 years from now, your rate is going to readjust. And I'm almost positive that 5 to 10 years from now, rates will be much higher than they are now. If you lock in a 30-year loan now at a fixed rate, you will at least know what your holding costs are for the entire ownership of that property. If you lock it in for, let's say, 7 years, you can really only guarantee that your payment will be the same for 7 years. If rates shoot up dramatically after 7 years, you're going to have to reevaluate if that property is even worth it to keep, and you're going to be subject to whatever the local market is at that time. And maybe it's not the best time to sell, maybe something happened in the short term, you have no idea, but if your plan is to hold it, you're going to have to reevaluate at that time if it even makes sense to continue holding it, because it totally depends on what the interest rate is. Getting a long-term fixed rate loan really just mitigates your risk of maybe the market's going down, interest rates going up, and possibly forcing you to sell when you wouldn't ordinarily sell just because the interest rate is too high for it to ever make sense. Either way, I really wouldn't recommend taking a short-term adjustable rate loan unless you're 100% sure that you're going to be selling after that time. If you know 100% you're only going to keep the property for like 7 years, then sure, don't get the 30-year loan, get the 7 to 10-year loan. But if you know and you intend to keep the property for a long time, but you just want the lower interest rate up front, it's very short-sighted to think that way. And there's a huge risk that interest rates spike up, and that severely impacts your cash flow once that happens. And for the way I see it, real estate is one of these markets where time in the market will outperform timing the market. And then my fifth and final rule is make sure it cash flows. In many scenarios, your market is not going to be like Los Angeles, which just has terrible cash flow, but insane appreciation. So in many situations, appreciation shouldn't be something that you count on, but would more so just be a great bonus if it happens. Instead, you should focus more on cash flow, how much money you are investing and how much you're getting back every single month in return. Do not barely operate on a thin margin of cash flow unless you're making a ton of equity where you have the cash reserve to pay for anything that could come up while you own that property. And the biggest problem I see with a lot of people is that maybe they're barely cash flowing on the property, maybe just like a few $100s a month, and then something drastic comes up. Maybe the HVAC goes out and it's $5,000 to repair that. There goes a few years worth of cash flow if you're only making a few $100s a month. Even if they've ended up making a ton of equity at the same time, or maybe it doesn't really matter, just making sure you have those cash reserves is so important. And this is much harder to do if your property is not actively cash flowing. So this is why I recommend focusing on cash flow first and then taking everything else into account later. So with that said, I really hope this helps you guys. And if you found it helpful, if you want to see more videos like this, if you've liked this video, do me a favor, hit the like button. And also, if you're not already subscribed, make sure to smash that subscribe button and also smash the notification bell so YouTube notifies you anytime I upload a video. Would greatly appreciate it. Thank you again for watching, and until next time.